payroll tax credits and deferrals, which is another form of relief that was contained in two recent acts that were passed by Congress, the Families First Coronavirus Response Act, which came out on March 18th, which now feels like an eternity ago, and the CARES Act, which was just signed into law on Friday. So, and I'll make a note as we go through some of these, but you'll see that for some of these credits, they do interact in some way with the Paycheck Protection Program that Erica just talked about. So just something to keep in mind. If you're eligible for one, you might not be eligible for the other, and I'll point that out, but just something that I also wanted to mention. So there were three major payroll tax relief measures in some of the recent legislation. There are sick and family leave payroll tax credits, at the employee retention tax credit, and then payroll tax deferral. And so I'm going to talk about each of those in a little bit more detail. Sick and family leave payroll tax credits. So the Families First Coronavirus Response Act created an Emergency Paid Sick Leave Act, which I'll just call the Sick Leave Act for shorthand, and then the Emergency Family and Medical Leave Expansion Act, or the Family Leave Act. And in addition, it created tax credits for employers that are required to provide paid sick and family leave under these acts. So just a quick overview of the acts themselves. The Sick Leave Act applies to government employers in addition to tax-exempt organizations and private employers with less than 500 employees. And it requires these employers to provide 2 weeks or up to 80 hours of paid sick leave if the employee isn't able to work for certain coronavirus-related reasons. I will say for part-time employees, they're entitled to the number of hours that they would typically work during a 2-week period. So the reasons for paid sick leave, an employee might be entitled or would be entitled to paid sick leave if they fall within any of these 6 categories. So if he or she is subject to a federal, state, or local quarantine or isolation order related to coronavirus, if he or she's been advised by a healthcare provider to self-quarantine or is experiencing symptoms of coronavirus and seeking a diagnosis, if the individual is caring for another individual who is subject to one or two, either subject to a quarantine order or has been advised by a healthcare provider to self-quarantine. If the individual is caring for a child whose school or place of care is closed or child care provider is unavailable due to coronavirus. This is a big one because I know, all the schools are closed at this point, or then any other substantially similar reason specified by the federal government. At this point, we don't really know exactly what that means. There hasn't been any further guidance kind of specifying a similar reason at this point. So the reason for the leave impacts how much the employer is required to pay that employee. So if the employee is taking leave for one of those first 3 reasons, he or she is entitled to regular rate of pay up to a maximum of $511 per day or $5,110 total. If the employee is taking leave for reasons 4 through 6, they're entitled to 2/3 of the regular rate of pay, up to $200 per day and $2,000 total. So the Family Leave Act, that was the other act that was part of the Families First Coronavirus Response Act, and it applies to most government employers as well as tax-exempt organizations and private employers with less than 500 employees. The Family Leave Act only applies to employees who are unable to work because they have to care for a child whose school or place of care has closed due to a coronavirus emergency. And in order to be entitled to paid family leave, the employees must have been on the payroll for at least 30 days. So that's a distinction. With the Sick Leave Act, there's not any requirement that they have been on the payroll for a certain number of days, but to be entitled to this family leave, they do have to have been on the payroll for at least 30 days. The Family Leave Act entitles employees to 12 weeks of job-protected family leave. The first 2 weeks can be unpaid, although it's possible that they might be able to use paid sick leave for those 2 weeks. And then after the first 2 weeks, employers are required to provide the employee with 2/3 of their regular rate of pay, up to $200 a day and $10,000 total for those 10 weeks. Okay. So the payroll tax credit, the Act also provides for refundable payroll tax credits that are equal to 100% of the wages paid under the Sick Leave Act or the Family Leave Act. And these credits include amounts that are paid for health plan coverage. Governmental employers, including government agencies and instrumentalities, are not eligible for the credit. And then the Act also provides for equivalent credits for self-employed individuals. All right, so for the payroll tax credit, the type of leave is going to impact, again, the tax credits that the employer is entitled to. So if the reason for leave is for 1 through 3, again, that is that the employee is subject to a coronavirus quarantine or isolation order, has been advised by a healthcare provider to self-quarantine, or is experiencing symptoms of coronavirus and seeking a diagnosis, the credit limit is going to be the employee's regular rate of pay up to $511 per day and $5,110 total up to 10 days. Okay, so just kind of picking up where we left off again, the type of leave is going to impact the tax credit that the employer is entitled to. So picking up where we left off, if the employee is taking leave for reasons 4 through 6, again, that would be caring for another individual subject to 1 or 2, caring for a child whose school is closed or child care providers unavailable, or another substantially similar reason specified by the federal government, then the tax credit limit that the employer is entitled to is going to be 2/3 of the employee's regular rate of pay up to $200 per day and $2,000 total for up to 10 days. And then for the paid family leave, which again just applies if the employee is caring for a child whose school is closed or child care providers unavailable, the tax credit limit is going to be 2/3 of the employee's regular rate of pay up to $200 per day and $10,000 total. So for small employers, there is an exemption for businesses that have fewer than 50 employees, but that only applies to the requirement to pay leave related to school closings or child care unavailability. So it does not apply to the other reasons, those other 5 reasons that an employer may be required to pay leave. And for this requirement or this exemption to apply, the employer must show that providing the leave would jeopardize the viability of the business as a going concern. The Department of Labor is expected to provide guidance on what exactly that means and what exactly a business would have to do to show that. The department has come out and said that it will be based on simple and clear criteria, and so we're still waiting for a little bit of additional guidance from the Department of Labor on that. Just a few closing remarks on the Families First Coronavirus Response Act before I hop into the CARES Act, which was the most recently passed legislation on Friday. The Sick Leave Act and the Family Leave Act are effective April 1st, so in just a few days here. And the payroll tax credits apply to wages paid for the period April 1st through December 31st. So those credits are only going to apply to wages that you start paying on April 1st during that period. How you take the credit is a great question, and we're still waiting for some guidance from the IRS on that. It was my understanding they were going to provide some last week, although they have not yet. I've been checking their website diligently. And so how exactly the credit is going to be taken, the IRS is going to provide some further guidance on that, including how perhaps the credit can be advanced and what you need to do in order to take that credit. So stay tuned, and we will, of course, be getting more information out on that once guidance is available. All right, so we're going to hop into some, yes.
Do you mind if I ask you a couple questions?
Sure.
So if I've had employees already take off because of doctor's orders, do I have to go backwards and give sick leave, or when does it start?
That's right. So it just starts April 1st. So you would not have to go back and provide those employees with sick leave under the Act, under the Sick Leave Act or the Family Leave Act, because they do not take effect until April 1st.
Okay, and so it's wages paid April 1st and after.
Correct.
Okay. What payroll taxes? So if you get a credit against your payroll taxes, which payroll taxes are those?
That's right. So actually, the IRS guidance, they were a little bit broader from some guidance that they posted that said basically you could use the credit against the employer and employee portion of payroll taxes, Social Security, and Medicare. You know, when you're filing your payroll tax return, your 941, and take it against those taxes as well as income tax withholding. So I think that was a little bit of a broader interpretation than most people expected, but a good one. And then if your payroll, if the wages that you pay exceed your payroll tax liability, the credit is refundable. So that's an important thing. I don't know if I harped on that earlier, but it is a refundable credit, so you would get that excess back.
Thanks, Maddie.
Sure. Thank you for your questions. And with that, then we'll hop into the two topics that were part of the recently enacted CARES Act, which was just signed into law on Friday. The first one is the Employee Retention Tax Credit. So the Employee Retention Tax Credit was created by the CARES Act. It is also a refundable payroll tax credit, and it is equal to 50% of qualified wages per employee. Qualified wages, which we'll talk about in a little bit more detail here in a second, but they cannot exceed $10,000 per employee for all calendar quarters. And this refundable payroll tax credit applies to wages paid starting on March 13th, so looking back a couple of weeks, through the end of the year, through December 31st. So qualified wages, they do include health plan expenses allocable to the wages paid. They do not include wages paid under the Sick Leave Act or the Family Leave Act. So that's kind of a way to prevent you from kind of getting both benefits if you're already getting a credit for wages paid under the Sick Leave Act or Family Leave Act. You're not going to be able to include those in qualified wages for purposes of this employee retention tax credit. And then qualified wages, as I mentioned, that the definition of that is going to depend on the number of full-time employees that the employer had during 2019. And then one other, and we'll talk about that a little bit more on the next slide, but one other comment is that aggregation rules apply. So companies with common ownership can be treated as a single employer, and that'll be important when we look at the next slide, determining, you know, the number of full-time employees that you had during 2019. You'll have to keep in mind, if you've got companies with common ownership, you might have to treat those as a single employer. So if a company had more than 100 full-time employees during 2019, qualified wages include wages paid when an employee is not providing services limited to 30 days per employee. So it has to be an employee that is still receiving wages, but they're not providing services, perhaps because the company has been forced to shut down, or we'll talk about a little bit later, their gross receipts have declined, have had a significant decline. So they're not providing services, but they are still receiving wages. And that's limited to 30 days per employee. For companies with 100 or fewer full-time employees during 2009, you can take all employee wages into account, subject again, though, to that cap, that it's going to be capped at $10,000 per employee. So eligible employers, so employers that are eligible for this employee retention tax credit have to meet certain criteria. The first is that they have to have been operating a business in 2020, and then they have to meet one of the following. So the operation of their business either had to be fully or partially suspended due to a coronavirus order from a government agency, that if they meet that criteria, they would qualify. Or the calendar quarter that they are seeking this credit for has to be within a certain period. And that period begins with the first calendar quarter after the end of 2019, for which their gross receipts are less than 50% of the gross receipts for the same calendar quarter in the prior year. And then it ends with the calendar quarter following the first calendar quarter for which their gross receipts are greater than 80% of gross receipts for that same calendar quarter in the prior year. So essentially what this is saying, you know, an eligible employer has to have been operating a business in 2020, and either has to have, the operation of that business has to have been, you know, fully or partially suspended due to a coronavirus order from a government agency, or they have to have experienced the significant decline in gross receipts when you're comparing that calendar quarter to the calendar quarter a year ago, that same calendar quarter a year ago. Ineligible employers, so as was the case with the paid sick and family leave tax credit, governmental employers, including government agencies and instrumentalities, are not eligible for the employee retention tax credit. And then this is an important point because Erica is going to talk about the Paycheck Protection Program here in a little bit, but employers who receive a small business interruption loan under the Paycheck Protection Program are not eligible for this employee retention tax credit. So that's important to keep in mind when you're evaluating sort of what benefits that you might be eligible for and what benefits you want to take advantage of, that being eligible, you know, if you take one benefit, it can preclude you from taking another. So an important point to keep in mind. And then the final topic I'm going to talk about today before I hand it over to Erica is payroll tax deferral. And this is another benefit, another relief measure that was part of the CARES Act signed into law on Friday. So the basics of that is that employers and self-employed individuals can defer payment of the employer's share of Social Security taxes payable for all reporting periods through the end of the year, through December 31st, 2020. And an important point to be made here is that the tax liability still has to be paid, so it's just deferred. It's not forgiven. It's just that you can retain that cash for a longer period of time and avoid having to pay those taxes through the end of the year. So the deferred tax liability is actually payable in 2 installments. You have to pay 50% of it by the end of 2021, and then 50% of it by the end of 2022. So again, just a key point, it's not forgiven. You do still owe that tax liability, but it's going to allow you to retain your cash for a little bit longer and defer paying it. The payroll tax deferral period it starts the date of enactment of the CARES Act, which was March 27th, and it goes through 12/31/20. And then again, another important point, because Erica is going to talk about the Paycheck Protection Program and possible loan forgiveness through that program. If you are a company that has received loan forgiveness from the Paycheck Protection Program, you're not eligible for this payroll tax deferral. So again, another important point to just, as you're evaluating which relief measures are most beneficial to you, to keep in mind that participating in one program could potentially take away the benefit of another program.
Again, I know you're asking questions, and we will have time for those at the end. And to the extent that we don't, we're going to answer those and get those to you. Also, I just want to stop now and say a couple things. One, thank you so much for joining us today. 2 hours is a long time out of anybody's day, especially in very stressful times. We do feel like it's an important 2 hours because obviously you need help. We all need help. Every business needs help. And this is designed to be a portion of that help. We're going to start out talking in very broad terms about loans under the Small Business Act, the Small Business, yes, which is called these loans, this loan program, as you see in the second bullet there, it's referred to all the time as Section 7A. Section 7A loans. Section 7A of the Small Business Administration Act authorizes and describes the programs that are available. And there are a half a dozen, let's say, programs. Some of them are designed for people who are exporting outside the country. Some of them are designed for startups. So there's different kinds of small business administration loans. This new Paycheck Protection Loan, which came our way on Friday when the president signed the CARES Act into law, is a 7A loan. So some of the rules that apply to a typical 7A loan apply to the Paycheck Protection loans. Some of the rules don't, because the statute specifically says, nope, this time that's not going to apply. Even before this disaster, there were and are disaster loans available through the Small Business Administration. We typically think of those as you well know, in terms of natural disasters, fires, floods, hurricanes, etc. But one of the disaster loan programs, and we're going to talk about it, is for economic injury, like Maddie said in the first slide. So we're going to talk about that. These SBA loans are provided to small business concerns. And there's a definition for both small and a definition for business concern. So that was the first question I had when I saw information about loans for small businesses is what constitutes small? How do you figure out whether or not you're small? And so the SBA has a pretty good website. I know it's crashed right now, and it's been crashed since last Thursday as far as I know. But if you can get on it, if you're up in the middle of the night sleepless, then there's a page and there's a couple links on there where you can go to a chart, which helps you determine whether or not you're small, or you can answer a couple questions and it'll tell you whether or not you meet their standards. Now, just remember, there might be a few exceptions. There are a couple of exceptions. The Paycheck Protection loans are a little bit broader than the average Section 7A loan. So they measure size, I say here, in two flavors, either by the number of employees or annual gross receipts. And then each of those, the number of employees or annual gross receipts, those amounts were set by reference to NAICS codes. And there's a big, long list of those NAIC codes and what constitutes the standard for each of those. When you're calculating what constitutes small, there is a rule that says you have to include everybody in your number of employees or in your gross receipts that is an affiliate. And unlike what we're used to in the income tax laws, there doesn't seem to be a really good, solid definition of affiliate. Instead, we have this mushy party with the power to control. Well, you could have an autocratic boss with a party to control, power to control, and not think of them as an affiliate, of course. But the power to control is automatic if there's an external party with 50% or more ownership. You can have less than 50% ownership, and there could be another way to control. One of the suggestions in the materials that I've been studying is there could be a contractual relationship that results in someone having the power to control. It's not necessary that party exercise that control, just that they have the ability to do so. So here's some examples on both the number of employees and the gross receipts. So if you're a dog food or cat food manufacturer, I might say, you have 1,000 or fewer employees, you're a small business. If you're a sawmill and you have 500 or fewer employees, you're a small business. If you're a new car dealer, it's 200. An airline, it's 1,500. Some businesses, like I said, are measured by gross receipts. Bookstores, $30 million or less. Dentists, $8 million or less. Hospitals, $41.5 million or less. And hotels, $35 million or less. The materials that are available indicate that there are times when the SBA has discretion as to how hard and fast it sticks to these rules. There is actually an appeal procedure if you feel like that you've been mischaracterized or misclassified. So the SBA encourages everyone to apply and to explain, if necessary, and we're going to talk about these application processes, why it is that you think even though you exceed these limits, these guidelines, that you should still qualify as a small business. So a few minutes ago, we said that you had to be a small business concern. A business concern is typically, the definition in the Code of Federal Regulations is this: a for-profit business entity with a place of business within the United States, operating primarily within the United States, or significantly contributing to our economy. And then the legal forms, as you can see, are pretty broad. It captures everybody. Now, again, we're talking about standard 7A loans. It captures everybody but your perhaps your independent contractors. It does have individual proprietorship. So in the actual paycheck protection loans, those independent contractors are available or eligible also. There are groups that are not considered business concerns. I've listed them on this slide. I'm confused. I'll acknowledge that I'm confused. It says gambling businesses, and yet when I look at the size standards, it lists casinos. So why is that? Just candidly, I've not had the time to look and see how the statute or the regulations define every single one of these things. And so that's the reason for the question marks at the bottom. If life insurance companies and financial institutions, I can understand those groups get thrown out of a lot of rules. The other ones, we would have to do a little digging in if you're within one of those categories and you're interested in one of these loans. Okay, so Paycheck Protection Loan Program. And if I call it the Payroll Protection Loan Program, that's just because I started out using the wrong word and I'm still recovering, still trying to get the word right. So this is a 7A loan, but there's going to be differences between it and a standard 7A loan because Congress wanted this program to be broader. It was created as part of the CARES Act that was passed and signed on Friday. Some of the expanded eligibility includes, like it says here, veterans organizations, tribal businesses, sole proprietors, independent contractors, and eligible self-employed individuals. And you're thinking to yourself, Erica, you just said on the other page that sole proprietors were included. You're right, I did. So my apologies for this being included under expanded. And there's been a lot of buzz about these loans. So why is that? What's all the fuss about? Unlike other 7A loans, these paycheck protection loans are eligible for potential loan forgiveness. So if a loan is forgiven in whole or in part, obviously some portion, whatever is forgiven, becomes a grant as opposed to a loan, as you don't have to repay it. I didn't put it on the slide, but let me say here that whatever is forgiven is labeled cancellation of debt income, but it is also expressly stated that it is not taxable. So if you get loan forgiveness under one of these loans, that amount will not be considered taxable income. There are no SBA, nor are there supposed to be any loan fees associated with the paycheck protection loans. There is a distinction, however, between fees and costs. So if the bank charges you a recording fee for doing some documents at the courthouse or for some other reason, those sorts of costs are likely going to have to be reimbursed and would be distinguished from fees. let's talk about this application thing for a minute, and if I have it later, then I'll talk about it again or not. But we're going to talk about the economic injury disaster loans. Typical small business loans, you go to the bank. There are loans that are there are lenders that are SBA approved. For the economic injury disaster loans, you apply directly to the SBA. For these paycheck protection loans, once again, you're going to go to the lender. So if you haven't already reached out to a lender, your bank person, go ahead and, as I said someone earlier today, get in the queue. Call up the person with whom you have your banking relationship and say, hey, I'm not 100% sure yet, but I'm thinking I want to apply for one of these paycheck protection loans. You guys may or may not have your paperwork ready yet, but I just want you to know that the moment you do, I want to be the first person to know. And so make sure you ring that bell so that when the bank is ready and can do something, they do. So Forbes reported that U.S. Bank has a pre-application online that you can fill out. At least one or two other banks have said, large banks have said it's going to be the end of the week or sometime next week, maybe even longer, before they know what the SBA is going to require and can then execute the application process. So this is all about cash flow, right, folks? I mean, that's the big deal. If your business has dropped 75% or 100% or 50% or whatever the case is, you need to preserve cash. And these loans are about getting you cash. Well, we need the cash now, but there is still going to be some time before the cash comes to fruition. And we all just have to manage that to the best that we can. So in the regular 7A world, you can only apply if you can't get credit elsewhere. That's waived for the paycheck protection loan. In the regular 7A loan, you have to give a guarantee, a personal guarantee, and collateral is required for loans over a certain amount. That's waived. The bank, in order to participate, the lender, in order to participate in this loan program, has to agree to a deferral of payment of both principal and interest for at least 6 months. It has the latitude to go to 1 year. Ultimately, if there is an amount that is not forgiven, then the amount that has to be repaid can have a maximum 10-year term. The interest is capped at 4%. There's no prepayment penalty for these loans, for paycheck protection loans, and there's a waiver of the affiliation rules for the hospitality and restaurant industry, and I'm sure you can understand why. So those are some of the things that make this loan so attractive. The potential that you're not going to have to pay it all back. The fact that you don't have to say, well, I do have this line of credit or I do have this savings account that I could go to. Although let's put an asterisk by that, and we're going to come back to what you do have to say. No personal guarantee or collateral, a deferral, again, helping on the saving of the cash, a low interest rate. It's curious to me. It's going to be interesting to see whether banks, lenders compete against each other and so set the interest rates lower or increase the deferral periods. I don't know what that's going to be like. So here's what you really want to know, right? How much can I borrow? How do I have to spend it? How much of it will be forgiven, and how do I get the loan? And I touched on that. We'll talk about it again. So how much can I borrow? So here's how much the loan will be. The loan will be the lesser of 2.5 times your average monthly payroll cost, or $10 million. So you look at the prior 12 months payroll, divide by 12. You say my average monthly payroll cost is $400,000. 2.5 times that is $1 million. So I get to borrow $1 million. If your average monthly payroll cost was $3 million, for example, you'd be limited to the $10 million. So 2.5 times your average monthly payroll cost. Exactly what months are included when you calculate that average is a little bit up in the air. The lender is going to tell you that. The statute says loan date, but that would be a moving target, right? Because we don't know when the loan date is going to be. And I would think that the lender is going to set the amount of the loan before the loan date. What constitutes payroll costs? So 2.5 times of what, Erica? Here's the list: salaries, wages, commissions, cash tips, sick and other leave, retirement payments, state and local taxes. But you can't include individual employee compensation in excess of $100,000, FICA, employee share or employer share, federal income tax withholdings, employees whose principal residence is outside the United States, and sorry about that, we rearranged the slides, qualified sick leave wages or qualified family leave wages that will be discussed later instead of earlier. Maddie will cover that in a minute. So when you're calculating the payroll cost, it's almost all of your payroll costs, health insurance, that should really be on there. Almost everything except for the things that are in the excluding part. If someone in the organization makes more than $100,000, it doesn't mean that person's compensation is thrown out in its entirety. There is a formula, or there is going to be a formula to allow you to prorate that. So I've had that question come up. Do you mean if the whole $100,000 goes out or what? And the whole $100,000 doesn't go out. You just get a part of it. Back to average monthly payroll costs. So 1 year. If you haven't been in business for a full year, there is a provision that addresses the time period you're supposed to use. If you're a seasonal employer, there is a provision that addresses how you deal with that. Payroll costs, what does that mean? I've put a definition of the key points of that here on this slide. I'm still all shook up over having typed greater than instead of lesser than. Sorry, guys. Salaries, wages, commissions, cash tips. That's fascinating. Sick and other leave, retirement payments, state and local taxes. Excludes individual employee compensation in excess of $100,000. If an individual has compensation in excess of $100,000, then it's prorated. Exactly how that proration, that's an annual $100,000. Exactly how that proration is going to work is not known yet. I suspect either the IRS or the SBA or some combination thereof will let us know, assuming the SBA. They have 30 days to issue regulations. Surely to goodness we won't have to wait 30 days, but then again, they were busy with economic injury disaster loans crashing their website before this was passed. So everybody is swamped at this point in time. You exclude FICA, both the employee and the employer share. You exclude federal income tax withholdings if you have employees with a principal residence outside the United States. and you exclude, as Maddie said earlier, qualified sick leave wages or qualified family leave wages. How do I have to spend the money? I should have said, how can I spend the money? That's the real question. You can spend the money on those payroll costs, and I'm thankful that they didn't change the definition between those two sections. You can, if you have pre-existing mortgage indebtedness, then you can spend it on the interest, but not the principal on that mortgage indebtedness, rent, utilities, and interest on other indebtedness. So what's going to be important to us going forward here is both the amount that you can borrow, which is the lesser of 2.5 times your average monthly payroll or $10 million, and the uses. And one commentator suggested that you open a separate account for this money and put it in there to make your audit trail, your documentation for this really crisp and clean, because documentation for both this and the economic injury protection loan is going to be absolutely critical to make it work for you. Things that we can use it for, how we can spend the money. We can spend it on payroll, interest on mortgage indebtedness, rent, utilities, and interest on other indebtedness. I will go ahead and give you a heads up that you can use an economic injury disaster loan to purchase inventory. So how much of the loan will be forgiven? And this is going to be a subject of great debate, I am sure. So that I anticipate when the SBA does come out with regulations, this will be, I'm hoping anyway, a heavily covered topic so that we can all be clear. 8 weeks of payroll, mortgage interest or rent, and utilities. So if we go back and we look at how you can use it, payroll, interest on mortgage, rent, utilities, notice right away that interest on other indebtedness is not something that's included in the list of what can be forgiven. So if you use loan proceeds for interest on other indebtedness, then you can anticipate you are going to be paying back that use, that portion of the use of the loan. What else is kind of tricky? It's the 8 weeks. So remember, our calculation for the amount of the loan that we could get was 2.5 times our average monthly payroll. Well, 8 weeks. Is that 2 months, right? And then that half is supposed to be indicative of the mortgage interest or rent and the utilities. So you don't, you want to monitor that very closely, obviously, and make sure that you don't, and know that if you spend more of the loan proceeds for other things, if you do spend for other things, A, you've violated the loan agreement, but B, you're going to have to pay that back. So I say here in the third bullet that the amount forgiven can be reduced in certain circumstances. So in the event that, let's say you already had to lay people off, many of you have, and you bring everybody back, and your business just doesn't bounce back. You can't keep everybody despite the loan, and you lay off 25% of your workforce, or you give everybody says, wow, Erica, I'd rather just take a cut and pay than have to have X number of people let go. so you reduce pay by some amount. There's a formula, and in those circumstances, if certain thresholds are met, certain amount of payroll reduction or certain amount of number of employee reduction, then the forgiveness will be reduced by the same pro rata amount. So that's another way that you could end up owing more than what you borrow, is by finding yourself in a circumstance where you had to let people go despite the loan. Somebody asked, I think the question was, how do I know that they will pass along the forgiveness information? So there's actually an application that you will have, well, there's not one yet, but there will be an application for the forgiveness that you will have to complete. The lender has a specified number of days to respond to you regarding that forgiveness. The SBA reimburses the lender 100% for what is forgiven, so they're not out of pocket anything. The lender isn't, so there's no reason for the lender not to pass that along. And at least you do have that backstop of those 60 days so that you can press the issue if it comes to that. When can you apply for the forgiveness? Good question. What 8 weeks, Erica, do I use? What 8 weeks do I get to recover? So you get to recover your choice of the 8 weeks. Well, we know it's not going to be between now, right? Because this is a low number, but you have until June 30th. So let's say that you, if we just backed that out, if we go backwards from there, our 8 weeks would be all of June, the majority of May. So at the time that this was passed, they were thinking that you could get your workforce back up to full speed by early May, and then take that 8 weeks where your payroll is back to normal and or have forgiven that 8 weeks. What we know has happened since last Friday is that we've been told that we're probably all going to have to hang out 6 feet apart for longer. So that raises the question about whether or not Congress will push out the amount of time that you have in which you can calculate these 8 weeks. Date of enactment, March 27th, 2020, 8 weeks from then till the end of June 30th. Some of you, that might be good. That's always a possibility, and that's why we said at the very beginning that your individual circumstances for your business are going to dictate how all of this works out, and we can't know all those and don't know all those, but those are things that you can consider. We're just trying to give you the general rules. So documentation is critical. That's going to be true for both this loan and the economic injury disaster loan. There is a list of things in the statute that you have to provide or that you may have to provide. Federal payroll tax filings, state payroll and unemployment filings, canceled checks, payment receipts. I suppose if you pay your utility in cash. You know what? Somebody's asking it. Isn't it 8 weeks from the date of loan origination? So that's a great question. That is how it reads in the statute, and so that is one interpretation. that is not the interpretation that the majority of commentators have taken. And if it was 8 weeks from date of enactment, then I don't know why they would have given us this time period through June 30th. So that is a gray area. I really appreciate the question, Greg. I don't know the precise answer. I did go on there. I originally had 8 weeks from the date of loan origination, and then when everybody and their brother was saying that you could choose the 8 weeks, I went with everybody and their brother, and perhaps that was generous, but that is a gray area. It'll be interesting to see what the SBA says, and with a lot of things, we're just going to have to wait and see. The other things I was getting ready to say, payment receipts. So if you pay your utilities in cash or with a money order and you have a receipt, that would be one way of proving that. Any other documents necessary to verify the payments on mortgage, rent, or utilities. And you have to certify then that the documents are true and correct, that the amount of forgiveness requested was used to retain employees, pay mortgage, interest, rent, or utilities. You also have to provide anything else that's requested, whatever that might be or what that might mean. No documentation, no forgiveness. Utilities is broadly defined to include internet, telephone, most everything that you would think of there. So I don't know. Sometimes in a webinar, you all can, you can see the questions that other people are asking in the chat box. I don't know if that's true for you guys or not, but my colleagues are shooting answers to me, which I greatly appreciate. And we now have an internal debate about what that 8 weeks means, so that makes me feel better in terms of judging myself on the gray area there, and saying that the truth is we don't know. And you know what? There's nothing that I would like less than going to a seminar or a webinar on a very, very important topic and hear the person say, I just don't know. I just don't know. Well, maybe that, maybe this, maybe that, maybe that. So if that's how you're feeling, I feel you. And I'm sorry. But we just don't know. And those are the facts. They're unfortunate facts, but they are the facts. How do I get this loan? Like I said, you apply at an SBA-approved lender. The SBA has emergency authority to make more lenders SBA approved. Typically, it can't include a credit union. It can this time. But again, how long is it going to take the SBA to just decide who all can be a lender? You have to certify. Now, when I said earlier that you didn't have to have credit, you could have credit available elsewhere and still get this loan, unlike the typical 7A loan. You do have to say, you do have to certify that you are getting this loan because of the uncertainty of the current economic conditions, and it's necessary to support your ongoing operations, and then it will be used for these specific reasons: to retain workers and maintain payroll, make interest payments on mortgage, or pay rent and pay utilities. You also have to say that you have not applied for or received another paycheck protection loan. And that took me a while to understand the language of the statute, but it makes sense since there are multiple lenders. They want to get you on record as saying that, nope, I'm only doing this once. I'm only getting the money once. Okay, so that is payroll protection loans. economic injury disaster loans. Like I said earlier, this was a existing program. This program that was in the statutes before the CARES Act passed had certain requirements, and like the 7A loan, the Paycheck Protection loans, some of those requirements have been expanded or waived. It's not 100% clear if there will be more of those that the SBA thinks that it can take care of as a result of the powers that it has as a regulatory agency. These are what we know right now. The loans are working capital loans. They have to be used to maintain payroll, provide sick leave to people who are unable to work due to the direct effects, that's a quote from the statute, of COVID-19, meet increased material costs due to supply chain disruptions, that's COVID-19 specific. Here we are again with interest, rent or mortgage payments, and those mortgage payments is interest only, and repay other obligations unable to be met. So what do you see right away? You see right away that this loan, this economic injury disaster loan, EIDL, is broader in terms of what you can use the money for than the paycheck protection loans. You cannot use it to refinance long-term debt. You cannot use it to replace lost sales or profit. You cannot use it for expansion, which who would be doing that right now anyway, right? So you could be in the middle of an expansion. So I hear that. The location, your location must be in a declared disaster area. The entire country has been declared a disaster area. Kentucky specifically was declared a disaster area. I think it was a week ago Friday. You have to have suffered working capital losses due to disaster. It is also available in addition to, we talked earlier about small business concerns, 501c3 nonprofit organizations, small agricultural cooperatives, small businesses engaged in aquaculture, sole proprietorships, and independent contractors. 501c6s are not eligible for economic injury disaster loans. I don't believe they are eligible for paycheck protection loans either, but we can double check that. You have to have acceptable credit, and the SBA will make some determination as to your ability to repay. So in the typical EIDL situation, the SBA gathers a bunch of documentation, including X number of years of prior tax returns, personal financial statements, a relatively significant amount of documentation. The statute where these loans are broadened for purposes of this disaster says all they need to get is your credit score. They also base the amount of the loan on what they think you can repay, and the term of the loan is based also on what they think can be repaid. Apparently they have formulas for that, and the statute, it says that this ability to repay, that the SBA shall investigate alternative formulas. So they're looking for the SBA to be a little more understanding when it comes to what credit is acceptable and this ability to repay. What are the terms? There have actually been 3 acts passed by Congress and signed by the president. There was one signed March 6th, but it hasn't gotten a lot of attention. It was primarily, well, actually, it did, however, increase the standard economic injury disaster loan loan amount to not being able to be in excess of $2 million. It was either 1.5, 1.75 before that. The interest rate is 3.75 for small businesses and 2.75% for nonprofits, and the term could be up to 30 years. Collateral is required for loan amounts greater than $25,000. That is a requirement in the standard, in the statute before the enhancements from the CARES Act. I did not see any change of that in the CARES Act, even though, as you can see in these other bullets, a lot of the other things are changed. So a personal guarantee is required generally. It's not required here unless the loan is more than $200,000 or until the loan is more than $200,000. The borrower doesn't have to certify that credit exists elsewhere. Is available even if the business has only been operating for less than a year, which means it's available to startups. And it permits a borrower to apply for a $10,000 emergency grant. So when you apply, if you have already applied, you can go back and quote unquote apply for this $10,000 emergency grant. If you are in the application process or you are thinking about applying, then you can seek this $10,000 emergency grant. There's some indications that $10,000 in some cases will be forgiven. I can't be more specific on that right now, but there's some indication of that in some circumstances. As I said earlier, you apply online directly to the SBA. And the documentation, once again, of how the funds are spent is absolutely critical. So less than a week ago, when economic injury disaster loans were the hot topic of the day, or the paycheck protection loans, I was on a webinar with the Small Business Administration, and there were a couple things that the woman said multiple times. She said, apply, apply, apply. So apply if you want to go this route. And there is a place on the application where you can explain unique circumstances or something that there's no box for on the form that you think is important for the SBA to know. And the other thing she said was to print the application, complete it before you get online and start to work through it online. Otherwise, the system, assuming you can get on it, will time out. Then with everything on your computer, save, save, save. As you go along, you can start the process, stop, come back later. So all of those things are important, just like in daily life. So what I'm going to do now is turn the presentation back over to Jenny.
I think one of the big things, first off, is for one subset of people, what are nonprofits eligible for out of the things you discussed?
Nonprofits from the payroll tax side are eligible for those paid sick and family leave credits, as well as the employer retention tax credits and the payroll tax deferral. So good news on the payroll tax side, and I'll let Erica chime in.
On the loan side, there is no difference in terms of what you can borrow than the for-profits. So that is one thing that's relatively clear, believe it or not, is what you can spend the money on. I say that, and then I might say in 5 minutes, well, those bonuses based on achieving company profit, I don't know if that's payroll costs or not.
If an employers have already laid off their workers, can they hire them back at any point and start the 8 weeks when they hire them back and use those wages?
As far as, and when we're talking about the 8 week, I think that's a question perhaps dealing with the loans.
Yes, yep.
I don't know. What I do know is that if you have laid people off, it doesn't prohibit you from, a matter of fact, they want you to bring them back and employ them. I need to look at the specific dates in terms of when you incur the cost. I don't know if you could give them back pay. I'm doubting it, but I'll have to look at that. And whenever I speak, I usually tell the audience, it's never good for me to suggest what my gut tells me the answer would be, because laws aren't written with the gut in mind. They're written, they're a compromise, right? So remember a minute ago on that slide where we saw the small aquaculture business that was eligible for a loan? Somebody in Congress has somebody with a small aquaculture business that enabled them to get specifically in that statute. That's not something we incentivize that here in Kentucky, but that's not something that you might expect.
A couple questions about who can be exempt from the family leave requirements, particularly, a small company with 25 employees, can they be exempt from family leave? And that goes back to the Department of Labor is providing guidance for businesses with less than 50 employees on what is necessary to show that providing the leave would harm the viability of a business as a going concern. That does only apply, though, to the requirement to pay leave because the employee is caring for a child whose school or place of business is closed. So that is the only sort of leave requirement that it applies to. But again, we're still waiting on additional guidance from the Department of Labor on that, on what exactly those small businesses with less than 50 employees would have to show. What does it mean to be under a quarantine or isolation order, and does safe at home qualify as quarantine? I will say that this has been kind of an unclear area that some practitioners are seeking guidance on, given the governor's executive order, which is, healthy at home, but just recommends that individuals stay home, and at this point isn't sort of mandating that people stay home unless, of course, they've been diagnosed with coronavirus. And whether that qualifies as a state isolation order, that is something that I know some practitioners, particularly in the employment law context, because they deal more than we do with when leave has to be provided. We're sort of coming at it from the tax credit side, but that they are seeking some guidance on that. I'll just mention, as with anything in our presentation today, because this is so new and we're working through it, and we certainly expect additional guidance to be issued. Once that is issued, we're going to be working to get that out as quickly as possible, because I know there are still a lot of unanswered questions on a lot of these programs. How does the payroll tax credit work with a PEO relationship for payroll services? I'm going to sound like a broken record, but that is something else in the statute that it says that Treasury will provide some further guidance on and how that is all going to work. So unfortunately, we're going to kind of have to be patient with a little bit of that, but that is something that's specifically addressed, so they recognize that is an issue and intend to provide some further guidance on that as well. Let's see, a pay period in March that goes through April with a pay date in April. Does this qualify for the credit? I think that is maybe in reference to the sick and family leave wages. And so the credits apply to wages paid on or after April 1st. So you're going to have to look at the date that the wages are paid for, and it applies starting on April 1st. So if you've got wages that were paid for work done, or not for work done, but for a date in March, then the credit would not apply to those wages.
Someone asking, they have an employee that is at high risk, that is afraid to work. Is any of this helpful to him, any of the things we've talked about? So what we've talked about today, no. These are business programs. Since he's an employee, he's not a individual proprietor or self-employed. That is, however, what he, depending on his income level and his filing status, the rebates that are being sent to individuals, hopefully he'll get some of that money, and that could be of help to him for a time being. If Nicole, if you want to email info@deandorton.com separately, we might be able to talk about that a little bit more offline, as they say. Several questions about nonprofits. So 501c3s are the nonprofits that are eligible for the economic injury disaster loan and for the Paycheck Protection Program. My memory is that neither a 501c5 nor a 501c6 would be eligible, because the statute says 501c3s, 501c9s, which I think are the veterans organizations, are the ones that are eligible. Is a U.S. subsidiary of a Canadian parent eligible for the SBA loan if it has an FEIN and U.S. employees? I don't know, Nicholas. Have to get back to you on that one. Would a DSO, dental service organization, be an example of an affiliated party? That would depend on ownership and, again, power to control. So I can't answer Angela right here, right now. I need a little bit more information. Is there a difference between physicians and dentists in terms of gross receipts? Yes, there is. There is even a difference among types of physicians in terms of gross receipts. So have to drill down on that one a little bit. The U.S. Chamber of Commerce says you are eligible if you are a small business with less than 500 employees. Why would the dog food manufacturing company qualify? Because the dog food manufacturing company had, for it to be small, it had more employees. Well, it appears that everybody that would have qualified for a 7A loan qualifies for this loan also. But it is a point of confusion. It's a whole lot like the 8 weeks. Is the 8 weeks from March 28th through whatever 8 weeks later would be, or is it 8 weeks between March 28th and June 30th? So, Catherine, good one. I don't know the answer to that one. Once you receive the confirmation page regarding the SBA loan, I'm assuming this has to be an economic injury disaster loan. Do you need to do anything other than wait? Martina, I would wait patiently for just a wee bit. I wouldn't wait for very long. My approach, having dealt with taxing authorities for, I really hate to say decades, but anyway, is that the squeaky wheel gets the oil. So after a little bit, I would reach out and check on that if I hadn't heard anything. I think this question is, would a passive business such as rental properties qualify? If that's not the question, then you guys can just send it to us. For the economic injury disaster loans, my understanding is that rental properties would qualify. That's based on having heard the woman from the SBA say that during that webinar, not based on me reading it in black and white. My guess is, too, that, and that's why I had those question marks after passive, that there might be circumstances where that would be treated as not allowed.
I got a great question that kind of applies to both of us about what do you suggest is the best way to evaluate whether to take forgiven loans versus tax credits. And I think that is certainly something that to talk with, your Dean Dorton advisor or other professional advisor based on your specific facts and circumstances to see what you might qualify for, because as we have tried to stress, taking one benefit can preclude you from taking another. Loan forgiveness generally is a great thing. but you want to make sure that you would qualify for that. And I think that's a very fact-specific determination. And I don't know if you have anything else to add to that, Erica, but that is certainly something we just want to make sure is on everyone's radar as you're evaluating this, that you're aware that, taking one route can perhaps close another door.
Yeah. So that's one of those questions where Maddie and I want to say, yeah, exactly what she said. You need to get with the person who knows the most about you. Based on what we've talked about today, if we just look at what we do see on paper, what we do see in black and white, it appears. Now, if you can think of every caveat a lawyer has ever given you in terms of not wanting to be bound by what they were about to say, apply that to the following statement. It appears that the loans, either one actually, the Paycheck Protection Loan is the only loan that for which there is some forgiveness available, other than perhaps the $10,000 advance on the EIDL. But for the most part, the Paycheck Protection Loan is the only one that has this element of forgiveness. Anytime somebody wants to give you money and doesn't want you to have to pay it back, that's a good thing, right? Don't forget your documentation. It's limited in scope. We know that. So the economic injury disaster loan is a little broader in scope. Can I do both, Erica? You can. You can do both. Now you want to be very, very careful and make sure, again, all about your documentation, especially on your paycheck, well, both of them, but especially on your Paycheck Protection Loan, because you want to get all that money back. It appears on the face of things, subject to all the disclaimers that I could possibly give you, that the Paycheck Protection Loan and the Economic Injury Disaster Loan would be best, but again, talk to somebody that knows you or that is willing to know you about your specific situation.
I got a question of, is there a limit on the decline of gross receipts, which I think is in reference to the employee retention tax credit, and no limit. I mean, you have to show that this calendar quarter, your gross receipts are less than 50% of what they were the same calendar quarter in the prior year. So, if you can show that, then that is one way that you could be an eligible employer for this employee retention tax credit. Another way would be to show that you have been partially or fully shut down by a governmental order due to coronavirus. So either one of those things. I also got a question of if qualified wages is based on average number of full-time employees, do we exclude wages earned in 2019 by part-time employees? So, and looking at the full-time employees in 2019, yes, you would just look at full-time employees, which the definition of that refers to another section in the Internal Revenue Code. They have to be working at least 30 hours per week to be full-time. And that's what you would look at to determine if you have less than 100 or 100 or less or more than 100 in 2019. And then that determines whether you can take into account essentially all employee wages as qualified wages subject to that $10,000 cap, or if you can only take into account wages paid to employees that are not currently providing services. So employees you've retained, but that at the time, either because you've had to shut down or because of your decline in gross receipts, they're not currently providing services for you.
On this question about the $100,000 and how much of that person that makes $100,000 or more can be included in payroll costs. Some have read that if someone makes $100,000, the entire amount gets thrown out. That's not true, because there's definitely a reference to it being pro rata. Does that mean the whole $100,000 will get in? Well, no, because you only get 8 weeks of your payroll cost, so only 8 weeks of that. If you pay rent to a related entity, is that still an allowable cost under either of the loans? I don't know the answer to that. That's not the first time that question's come up. We'll poke around for that and see if it seems like to me that certainly has been answered before. If your business is closed to the public because you're a retailer and can't be open to the public, can you get the loan for rent and utilities? Yes, you can. still having a debate here on what the 8 weeks means. I appreciate the debate. So here's one. Are nonprofits eligible for paycheck replacement loans, 501c3s? 501c3s we know are. What about churches and religious private schools? I don't know. There is that religious businesses being ineligible language in the statute, so I don't know. Can you use an EIDL to pay off your business credit card? No, I would say no. You can use it to pay off what would be allowable expenses that you incur from the date of injury. And, that may be where the Kentucky-specific disaster declaration comes into play, is that may be the date from which your injury is measured. I don't know that for sure, but that, once again, I shouldn't say makes sense to me, but it does. Yes, you have to apply separately for an EIDL, and you have to, my understanding is you have to apply for the EIDL to get the $10,000 advance. That's actually an advance on that EIDL. You apply to the SBA for the EIDL and to a bank for the Paycheck Protection Program. Do I think bonuses would be included in payroll costs? I don't recall seeing bonuses listed in that list of what constitutes payroll costs. It's a pretty specific list. Now that I say that out loud, I'm thinking, did I see bonuses listed in that payroll list? Yeah.
Erica, I think I read that might be an area where some people are waiting on a little bit of additional guidance, that there's nothing excluding them, but, as with a lot of things, we're still waiting for that to maybe be cleared up.
Yeah, I can see how the answer could depend in part on, for example, whether or not this is a bonus program that you've had in place, over an extended period of time, not something that's just happening. And
right.
So I could see how that could have an impact.
I've got one that on the payroll tax deferral will Form 941 be updated to show the amount the employer is deferring, which is a great question. I suspect that the IRS will provide some guidance on that. Again, that program was just enacted in the law that was passed, or that was signed into law on Friday. So the IRS hasn't had much time to act, but I expect that, they certainly will. The law requires them to put out some guidance on how it is going to go into effect. So I expect that we'll see that, so that you will know what you have to do when you have to go to file your payroll tax returns.
Donald says he's not clear on what I said about churches and whether or not they could get paycheck protection loans. I can't imagine, Donald, why you weren't clear, because I said something like 501c3s are eligible, but for Section 7A loans, religious businesses can be excluded, but I don't know if that exclusion from Section 7A loans applies to paycheck protection loans. So crystal clear. Just kidding, of course. So I don't know. We'll have to investigate that one for you guys. What would be an example of a business that shouldn't apply for a PPL or a disaster loan, and can or would you apply for both? You can. I can do that backwards better than I can do it forwards. You can apply for both. A business that shouldn't, one that doesn't have an ability, that thinks they're never going to have an ability to repay, because, in the event that you get stuck with some amount and there's not loan forgiveness for, and you would be in a situation where you couldn't pay. That's the only thing that immediately comes to my mind. But there certainly could be other circumstances. I appreciate very, very much all of you today attending, and I apologize for the greater than as opposed to lesser of error on the slide, and any confusion that may have created. Maddie, before going back to Jenny, anything from you?
Sure. I'll just, I guess, echo that we really appreciate everyone joining today. And as we mentioned, we're, awaiting further guidance on some things, and our team is working to get out that guidance and clarification as it becomes available. So thanks again, and I'll turn it back over to Jenny.
We are happy to discuss with you, happy to talk to you about your individual situation and really take into account everything that's happening for you, because this is such an individualized process at this point with everything going on. So thank you once more, and we will talk to you all soon.